Do you know how to use a stop price? Do you know how to use it? Why to use it? Probably not, otherwise you wouldn't be watching this live stream. I'm going to explain it to you. I'm going to make it real simple, break it really down. There's two situations where you might want to use a stop price, and let's talk about what those things are. That's entirely enough of that. It's late. I got stuff to do. You got stuff to do. Let's get right to it. So we're going to talk about stop orders. So there's two key scenarios where you might want to use a stop order. And it's a very important type of order, but I know for some of you it might be a little bit confusing about how and when to use it. Many of you, perhaps a few of you, are familiar with one of the situations where you might want to use a stop order, but there's also another one that you might not be aware of. So I want you to think of a stop order functionally as just a regular market order, right? We did all the order types, right? Market, limit. I did that video. Take a look at it if you haven't seen it already. Market, limit. We covered all of them, right? Market order we talked about as being the fast order. I got to get executed right now, now, right? I want to get that GME. I'm trying to get a trip to the moon, right? So that's your market order. Let me get executed right now, the best, whatever the best price is right now, best available price. But obviously there's more to it than just market order. It's a market order with a trigger. And that's the way that I think to think about it to make it make sense. A market order with a trigger. Normally with a market order, you just enter the market order, send, boom, it hits the market, you get executed pretty much immediately at whatever the price it's trading at, whatever it is, right? GameStop, AMC, whatever it is, weed, whatever it is, right? You're going to get executed at whatever the best price is. The NBBO, National Best Bid and Offer. The thing with the stop order is it has a price that will trigger the order. So the order, this market order, is contingent on a condition or an event, right? That event being a quote or execution at a specific other price. So I think it would help you to better understand what a stop order is and when to use it if we actually look at an actual scenario where you might want to use it. So you've bought some GameStop stock, not GameStock, GameStop, right? And why did you do this? Because you want a trip to the moon, right? So that's your plan. You're trying to get to the moon. And you buy it at, I don't know, $100 a share. 10 shares, $100 each. And it's shooting up. It's 110, 120, 130. And you got this crazy idea. You've been sitting on Wall Street Bets, right? And they're talking about, ooh, I'm a diamond hands till $1,000. I'm diamond hands till $1,000, right? And you really believe it's going to go to $1,000. And it's riding up 150, 160, 170, right? Prices just going up and up and up and up, right? However, a little bit of common sense hits you and you say, hey, man, I've actually made a lot of profit right now. I bought at $100 per share, and now it's up to 160. I just profited $60 per share. What? That's pretty good, right? Now, I'm riding this wave trying to get to the moon being $1,000. But how do you know it's going to go to 1,000? Don't you remember a couple weeks ago when GameStop was launching? All the smoke was coming out and you were excited. You're like, yeah, I'm going to buy a Lamborghini. And then all of a sudden it was like this. And it, right? You're starting to remember, wait a minute. If that happened last week, it could happen now, right? And the last time it crashed so quickly, by the time I reacted, it already went below the price I bought it for, and I lost a ton of money, right? So you're getting a little nervous, get a little common sense, kicking in. You're like, I don't know, man. It might not be going to $1,000. So I got $60 per share profit right now. If I sell right now, I got $60 per share profit that I can walk away with, right? But I would like to try to get even more money, keep riding that wave, but just in case, I would like a little insurance in case it starts crashing, right? I want a quick exit strategy, quicker than I could ever get on my computer and enter orders, right? I want an automatic exit strategy to get me out and pocket those gains before you lose everything, right? That is one of the most common examples, I think, especially more so for retail, where you might use a stop order. Remember, stop order being a market order triggered by a stop price. So what are we going to do? Trading at $160 per share. It's going up and up and up and up. Sometimes it goes down a little bit, goes up a little bit. So what you want to do is you want to basically sell at a certain price, right? So let's say that it goes up to $170. Now, you could set it to like 169 as a trigger price. So it's going up. If it ever reverses direction, goes down from 170 to 169, boom, trigger your stop. Remember, what's the stop order? Just a regular market order triggered by a price. If that trigger price that you set is 169, if the stock goes up to 170, comes down to 169, trigger. Now what do you have? Market order, right? So you can get executed at the next best price. So maybe you get executed at 169 if it's available, 168, whatever. Problem is, what if it was just a little dip? Right? What if it was a little dip? So it goes up to 170, falls down to 169 for a few seconds. You put your stop there, fool. Well, you're not going to be a fool after watching this video because I'm going to show you what the right thing to do. You put your stop at 169. Really ridiculous. So it takes a momentary dip down to 169, triggers your stop, market order, boom, sell, you're out. Then, a few seconds later, reverse. 180, 190, 200. You're like, oh man, why did I sell? You got to give yourself a little bit of a buffer, right? So if you're going to put a stop price, you've got to use your discretion. Use your discretion based on the volatility patterns that you're seeing, how it's going up and going down, going up and going down. And give yourself a little buffer to where, so let's say the price is here, right? If it's here, but it's going up and down like this, you don't want to put a stop price anywhere in that range, right? Because if you put it in that range, boom, triggers too early. So you want to give a good amount of range. So maybe my stop price is here, right? So even if it dips back for a little bit, it goes back up, goes back a little bit more, goes back up, goes down a little bit more, doesn't trigger your stop order, right? So just in case it actually keeps going up, you were able to stay on board, right, for that trip to the moon, right? So when you're picking your stop price, make sure that you give room for momentary volatility where the price might drop a little bit and then go back up, right? So that's one of the things to consider. But that's the way it works, right? So you put your stop price. If the price reverses in terms of the market's going up, now the market starts going down, starts crashing, then you can potentially get out. Now, why I say potentially is there is a little bit of a problem where you might actually find yourself in trouble with this stop order actually potentially not saving you. So
the way that the stop order works is you are, again, trigger price, which activates a market order, right? Problem is, you got to get hit. You got to get hit. What if your price never gets hit in terms of never trades at that price? What if there's a gap, right? You ever see GameStop? It just goes like, so it's trading at 170, and then the next quote is like 150 or something. It doesn't have to trade every single price, right? It can go down so fast that it's like it's gapping down. Now, if it goes down too aggressively, obviously there's the circuit breakers that might trigger, where you'll see they'll do a trade halt, and I think they'll do, I forget the rules right now, but I think there's 2 times in a day, so there's a percentage drop that they'll allow, and then they'll pause the market for a little bit, and if it does it again, I think the second time, then that's it. No more trading for us today. I believe it really depends on, there's a range of how much it can go down, and that will trigger certain events. So don't quote me on that, but that'll happen also. But the bottom line is, in order for your stop order to trigger, it's got to trade through that price. So there needs to be a quote at that price that you set, or an execution at that price that you set, right? So that it can activate, and then even then, theoretically, if it's moving down really aggressively, if there's a quote but not an execution, in theory, I'm getting theoretical now, if there's a quote but not an execution at your stop price, I mean, you're not going to get executed if there's no execution at that price, because remember, after your stop price is hit, then it becomes a market order. Now, in order for the market order to get executed, you need someone to basically be on the other side of that. So, not quite sure how that might work, but that's something to consider. So just be aware that if you're trading something that's really, really volatile, there is a possibility that your stop might actually not be triggered. Be mindful of that. Now,
the other scenario where you might want to use a stop order is, let me take a look at the chat. Take a look at the chat. Another situation where I might want to use a stop order is, and this is not so common, I think, with retail, because a lot of these discount brokers that a lot of guys are using now don't permit short orders. So you can use a stop order in both directions. We talked about the price going down. So you're putting a stop price or trigger price below the current market price, right? So you're looking for an event where the price starts going down, trigger, market order, get me out, right? But you can put a stop price that is actually above, you know, I told this iPad to do not disturb me until tomorrow. Why are you sending me alerts, dude? Apple. And I can't turn off the Wi-Fi because I need it for the presentation, which I'm about to do for you guys. But anyway, I love Apple. So, short order. You can put a stop price above market price. Why would you do that? Why would you put a stop price above the price that the stock is trading at? Because if you remember, and again, this is another video, take a look at it. It's on my channel. And by the way, if you're watching this video still, Clearly, it's helping you. So why don't you click on the like button, subscribe, and smash that bell? And welcome to Carlisle Speaks Wall Street. With options, your entire strategy is based on what you... I'm going to give you the fixed protocol. Options Greeks. Options Greeks. So, I did another video on this channel talking about short orders, basically shorting stocks. I think a lot more people know about shorting stocks thanks to the big squeeze of GameStop. But just a quick review. With selling short, you're selling shares of a stock that you do not own. It's essentially a loan. You pay interest on that loan until you close the loan out. And the way you do it with stocks is you need to buy back, right? You borrowed shares, right? You put the sell order. There's a whole process of finding locates. I'll talk about that in another video. But basically, those shares don't belong to you, right? So you sold short, you have that money from the sale, right? Now you're hoping the price goes down, and then you're going to buy them back at a discount, profit from the difference, if things work out your way. But the key thing is you need to do what's called buy to cover, right? You need to cover your short eventually, right? Because, again, it's a loan. So what if you decided to go against Wall Street bets? You said, look at these losers sitting in here with their diamond hands. They're such a bunch of dummies. It's not going to $1,000. It's going to crash like a rock, right? That's the essence of trading, right? You're always betting against someone else. Remember, any trade you do, there's someone on the other side. Someone disagrees with you. Someone has to disagree with you, essentially, in most cases, because there's other reasons to trade, but generally someone has to disagree with you to trade with you, right? In terms of being on the other side of the trade. So if you're selling short, there's someone else who thinks it's going to go up. You think it's going to go down. I think it's going to go up, right? So you could be wrong, obviously. So you're shorting something thinking it's going to go down. What if it goes up? Now, with short orders, the losses are infinite, right? Because you're going to have to pay whatever the price is for the stock to cover your short, right? So if you shorted GameStop at, see, I said stop. Anyway, if you sold short GameStop at $150, right? Thinking it's going to crash like a rock. And then it starts going up 160, 170, 180, and it's making no sign like it's going to reverse. I swear, Apple, Anyway, remember, the higher that it goes, the more you're going to have to pay. So how about you protect yourself against it actually going to the moon and hitting $1,000, and now you have to pay $1,000 per share to buy it back, right? That would be bad. Enter stop order. Now, you can enter a buy stop order, right? Before we were selling, we wanted to close out our position. You were holding a stock, you were going long, all right? You're holding a stock, and you were concerned about the price going down, which would hurt you. You're going to lose, right? So you put that stop order to close out that position. Same thing here in reverse, right? If things don't go your way, you need to get out before the price gets too high, because as high as it goes, you're going to have to pay, right? So you can use the same strategy to protect your shorts, right? What you do is you say what your risk tolerance is. I know it's kind of going up a little bit right now. It might go up to $180 or so, but it's not going to go much higher than that, right? About $180 or so, and then it's going to crash like a rock, right? Maybe I'm wrong and it goes up to 190, but if it's going up to 190, that's bad. I don't want to go any higher than that because that doesn't look good, right? So change of plans, abort. So you have sold short GameStop, You put in a. Remember, you sold shares that you don't own, so you owe those shares back. You got to buy them back at some point. You're hoping to buy them back for a lower price. So what you can do here is you can put a buy stop order at 190. Right? Remember, we're talking about a market order. Oh, that's nice that I'm getting a notification that I'm live 10 minutes after I started. But anyway, YouTube. So 190 that's it. If it hits 190, you're scared. I don't want to risk it anymore. I want out. And I want it to happen automatically, right? I don't want to miss it and it's moving up too fast. So you put a stop order. Remember, just a market order with a trigger price, right? Stop price 190. Buy 190, right? Buy GameStop 190. So you're thinking it's only going to go up, maybe 180, going to go down. It actually goes 185, 190. Okay, deal's over. You want out. You already put your stop price. So once it hits 190, quote it at 190, trade it at 190, either or. Boom, your order becomes a market buy, right? Buy GameStop, whatever the shares are, to cover your position. So automatically it triggers, and now you've bought back the shares. Now, you might need to add some extra funds to your account because obviously the price is more than what you got from the short. But due to margin requirements, you should ideally have enough funds in there, and if not, you need to add funds to your account. But that's settlement. That's a whole nother story. But bottom line is that's another case where you can use a stop order as a clever trick to sort of like an insurance to save yourself from getting in some big trouble. So that's so those are the two main things. So you're going long on something and it's going up and you want to ride that wave, but you're concerned about the stock tanking, right? So you set a price below the current price that if it falls down to this low, then I don't like it anymore. Get me out. But remember, be mindful of gaps where the price moves very quickly and maybe your order doesn't get triggered. You need to have a quote or an execution. And again, the other one is sell short. You need to cover your short, so you need to buy whatever the amount of shares that you've sold short, right? So you put in this order. Again, it's just a market order, but it has a trigger. It doesn't actually become live until you hit your trigger price, right? So just think about the stop order. You have a stop price, which is your trigger price. That's the price that converts your order live. So basically, imagine that the stop order is kind of sleeps in a way, right? It's sleeping and it's waiting for an event. What's the event? For your price to be hit, whatever the price is, quoted or executed at. Then once that happens, it's almost as if you just entered a market order for whatever shares that you put it in for. It's really that simple. It's really that simple. In fact, I was going to do a little diagram. I mean, I don't know if this will help you guys at all. I think I've been pretty clear on how this works. But if you can see this, so let's do some prices here. So we have, oh my goodness, look at the handwriting. 200. Holy moly. Where did you learn to write, dude? 150. All right. Let's do 140. All right. So let's change this color to something else. How about this? So let's say current market price is here, right? So this is what the stock is currently trading at, right? Now, it's going up, and you want to continue riding that wave up, right? But you're afraid it might reverse direction. So what you can do, you can enter so this is when you're long. So you've bought a certain amount of shares at a certain price. So we're long in this example. You can put a stop order with a stop price of 140, right? So the idea is if this price, so the stock is trading, it's going up, it's going up, it's going up, but let's just say all of a sudden it reverses, so now the price starts going down. You don't have to sweat and worry about, oh no, I gotta get out of this. It's already set. You already put a stop order, right? So as soon as the stock is quoted at or executed at 140, which you put as your stop price, now you've got a market order. So therefore, it is going to basically trade at that point. So it's now you got a market order. Remember, market orders are for you want an execution as quickly as possible at the best price, basically NBBO, National Best Bid and Offer, and that's all there is to it. Inverse this scenario, inverse the side. So instead of selling, buying, right? Instead of price going down, changing direction and going down, now we're talking about changing direction and going up, right? Or it could just be that it continues to go up. Maybe it's at, let me keep it simple. So with the buy cover, you just want to know if it goes higher than a certain amount, then basically you want to buy to cover your short. And that's all there is to it. It's that simple, guys. Now you are a master at selling short. All thanks to Carlisle Speaks Wall Street. And you thought it was complicated. It's not complicated. I'm going to, bonus content, because you dared to sit here and listen to me blab about stop orders for, how long has this been going on now? What's the timer on this thing? I don't even know what's going on. There you go. 27 minutes. You've been watching this video for 27 minutes. Congratulations. You deserve a bonus. Click on the like button, subscribe, smash that bell. But bonus content for somebody that stayed this long. Obviously, this is of value to you. So what we are going to do is, let's see. I need to get over to this screen. Holy moly, I didn't even, let's see, left screen. Apologies. I should have already had my screen set up. Come on, guy. Display capture. Huh. Well. Let's do existing. Let's do right. What, are you gonna crash on me? Holy moly. I selected this. I say okay. Holy moly. Wow. That was just so difficult. Why did it have to be so difficult, man? All right. So we are going to look at an actual stop order. Or we're going to create one right now, so you guys can see what it would look like. The real deal. Let's drop this down so you can see the back of my ugly head, because I know you guys love to see that. His head looks like a coconut. That's childish. Come on, guys. All right, so here we have order entry. So let us put in something else. Let's put in a GME stock, and let us do a sell. Let's put a quantity. We will put a quantity of 7, and then see where it says limit. Instead of limit, we're going to say stop. And that's it. So all we have to do is enter our stop price. And then this is the price that's going to trigger the stop order. So this order is just going to sit and wait until that price gets hit, and then it becomes, again, a market sell. Now, let me give you the bonus content. What about if you want an extra insurance policy? So you don't want to sell your stock for less than a certain amount. No matter what, you don't want to sell it for less than a certain amount. Or you don't want to pay more than a certain amount, right? Let's say, for example, this is actually a good one. So GameStop, right? So you said that you want to, so you short GameStop, right? So the higher the price goes, the more you have to pay, right? So if you end up being wrong, you thought it's going to go down and it ends up going up, there's no limit to how high it can go. So if you use a stop, just a regular stop order, to basically cover your short, remember, it creates a market order. So what happens if you put a stop price of, I don't know, well, like I think we said like 190. So you put a stop price of 190. It's quoted at 190. Your order gets triggered, so it becomes market. The next execution, because it's going up really, really fast, what if the next execution is like $200 or $300 or something? Now, fortunately, that's probably not very likely because again, the market order is very aggressive, right? You want to get executed right away. So the idea of the price gapping that much, not very likely, but technically I don't see any reason why that wouldn't be the case. But one thing for sure, there could be a huge gap in price. Bottom line is, if you have a large position, even paying an extra $10 per share, if it gaps up at $10 or it gaps up $20, that could mean millions. Not for us, right? But still, it could be a lot of money. So you might make a decision. So let's go institutional. So you have a big order that's that big, right? Where an extra $10 or $20 can mean millions in losses. Because you're saying buy back, right? It hits a trigger price, just go and buy back, right? Next available price. So if it jumps up really high, all of a sudden you end up paying a ton of money and for no reason. There's a decision to be made. You don't have to cover your short at that moment. The longer you have the short open, you're paying interest on that loan. So you got to make a decision. What is the amount of loss that can be incurred by you continuing to keep that short position open versus what are the potential losses that could be incurred by you potentially paying an extra $20 per share on the stock if it gaps up really quickly. If your stop triggers and then it gaps up really quickly to where, it's like $10, $20 per share. You might think, well, you know what? I'd rather pay the interest on that loan. So keep the short position open a little bit longer, because even if it goes up that high, I mean, come on, it's not going to stay up there, right? So you may decide you could wait it out. So what you might want to do is, instead of doing just a stop order, you do a stop limit order. Now it's the same principle, except instead of it being a market order with a trigger, it's a limit order with a trigger, right? So you can put a limit and say, I'm not paying any more than $200, right? So you put the same stop price of 190. So quoted at 190, Your order now goes live, but it's not a market order. This is a stop limit. So it becomes a limit order, right? So limit or better, right? So that means if you put a limit of 200, that means if the price quotes at 190, so the stock quotes at 190, triggering your stop order, your buy stop order, right? And if it gaps up to 201, right, that's above your limit. So you won't get executed, right? So you can continue going up 300, 400, doesn't matter, right? Nothing will happen because there wasn't an available execution at the price that you set, right? The stock moved too quickly to where it was above your limit, so it's nothing, right? So you don't get executed. So now you're still short GameStop, and now you just have to wait it out. And you're just hoping that it doesn't stay up there too high. I mean, the interest can be very high. I've seen 30%, 40%. I think much higher than that. Really depends on a lot of different factors. But again, it's a balancing act. The losses from the interest versus the losses from paying $10, $20 more per share. So there you have it. Stop orders, stop limit orders, both directions. A stop price below, stop price above. And remember, these are just basic standard orders, but they have trigger prices. A market order with a trigger price or a limit order with a trigger price. That's a stop order and a stop limit order. It's really that simple. If you don't have a paper trading account, I recommend you get one. Interactive Brokers offers that. You can also use Investopedia, because although I think I broke it down pretty good that you guys can understand, most of you, everyone learns differently. I think the important thing now is for you to practice it so that it really resonates and stays with you, because otherwise you're gonna forget, right? So if you're happy right now, you're like, yeah, I finally understand. I'm happy for you, but you should probably practice it so you can remember how and when to use stop orders. Again, if this video has been helpful for you, you know what to do, man. Go ahead and click on that like button. I really appreciate it. I think on one of my recent videos, it's so embarrassing. I was crying all night long. I got 4 likes, man. I took time out of my day to help people out, and I only got 4 likes, man. So don't make me cry again. It's embarrassing. So click on the like button. Make me smile. Otherwise, no, I'm not going to threaten you. This is Carlisle Speaks Wall Street, and that is how to use a stop order. How and when to use a stop order and stop limit order. Subscribe for more videos like this. We're going to talk about more trading techniques, order types, and things of that nature, especially the technology behind the trading. Right here in Carlisle Speaks Wall Street. Thanks for watching. Ciao. Buonanotte. Aroma. Let's do that again. Aroma. With options, your entire strategy is based on what you... I'm going to give you the fixed protocol. Options Greeks.